Hey everyone, and welcome. Today we are going to pull back the curtain on a really powerful but super simple shortcut in finance. It's this little secret weapon that helps you figure out just how fast your money can grow. So yeah, let's just dive right in.
No, seriously, just think about that for a second. What if you had a tool, something you could do in your head, that gave you a surprisingly good idea of how long it'll take your investments to, well, to double? Forget about those crazy spreadsheets or clunky financial calculators. I'm talking about a clear, simple answer. Now, that powerful force we're talking about? It's compound interest, of course. You know, the thing Einstein supposedly called the eighth wonder of the world. And this little tool we're going to unpack today, it takes that almost magical concept and makes it real. It makes it predictable, and it makes it something you can actually use to your advantage, like every single day.
All right, let's get into it. So at the very heart of investing, there's this one big question that, let's be honest, we all ask ourselves: how long is it going to take to double my money? It sounds so simple, right? But actually doing it, well, that's where it gets a little tricky. And look, this is a real dose of reality that every single investor needs to hear. The market just doesn't hand out 100% gains for fun, you know? Chasing those massive quick wins, trying to perfectly time everything, it almost always leads to disappointment and a whole lot of unnecessary risk. It just feels like you're at the casino. So what if, instead of trying to catch lightning in a bottle, what if we could tap into this slow, steady, but unbelievably powerful engine for growth? The real secret isn't finding some random stock that doubles overnight. No, it's about understanding the math behind compounding and, you guessed it, the simple rule that governs the whole thing. And here it is. That secret rule is called the Rule of 72. I'm telling you, this is the ultimate shortcut for investors. It's this beautiful, easy-to-remember formula that just cuts through all the noise and makes the whole idea of doubling your money crystal clear. And that's really all it is, a super simple definition for a really powerful idea. It basically just links together two things that matter most: your rate of return and time. And it tells you pretty much exactly how long it's going to take for your investment to double up. And using it is ridiculously simple, I promise. No crazy math, no calculus needed here. All you need to remember is the number 72 and whatever your interest rate is. That's it. So let's run through a couple of quick examples so you can see how it works.
Okay, first up, a super common one. A savings account that's earning you maybe 1% interest. A lot of standard bank accounts are like this. So you take 72, you divide it by 1, and you get 72. Yeah, 72 years to double your money. That is an entire lifetime just to see your cash multiply one time. And that's not even factoring in inflation, which is a whole other story.
Okay, but let's switch gears. What if you invested that money in a portfolio that averages, say, an 8% return, which, by the way, is pretty close to the historical average for something like the S&P 500. Now let's do the math. 72 divided by 8, that's 9. All of a sudden, we're talking about just 9 years. I mean, that is a massive, massive difference. What took a whole lifetime now takes less than a decade. And just to really hammer this point home, what if you were a great investor and managed a 12% annual return? Well, 72 divided by 12 is 6. 6 years. Just think about that. And about the time it takes to get through middle school and high school, your investment could completely double. It just goes to show how critical your rate of return is. Every single percentage point literally shaves years, sometimes decades, off your timeline. So this is the really big takeaway here. This isn't just about playing with numbers. It's about truly getting a feel for the immense power of compounding. Those little differences in percentages, going from 1% to 8%, they might not sound like much, but they create these gigantic, life-changing differences in your financial timeline. And this quote from the Wall Street Journal just nails the frustration perfectly. I mean, when interest rates are super low, it's awesome for people who are borrowing money, right? But for the rest of us who are trying to save and, grow our wealth, it can feel like you're just running on a treadmill, going nowhere. It really points out this basic tension in how money works. So let's put this side by side. Imagine two people. On one side, you've got the saver. They're earning a safe 1%. For them, doubling their money is a 72-year marathon. On the other side, you've got the investor. They're earning 9%. For them, it's an 8-year sprint. It's the exact same starting amount of money, but the outcome is just worlds apart. And wow, look at this chart. It just lays it all out, doesn't it? That isn't a small gap between the two. That is a massive chasm. That bar for the saver just towers over the investors. It's like it's visually screaming at you about the real cost of low returns over time. This is what we call opportunity cost, right here, in living color. Okay, but here's where we need to get serious for a minute. We have to be careful, because this powerful little rule, it's not just for calculating how fast you can win. It also shows you the brutal, totally unforgiving math behind investment losses. And this is something that every single investor has to understand deep down. All right, let's play out a scenario. Imagine you've built up a nice portfolio, say $100,000. You worked hard for it, you invested it pretty wisely, and you feel like you're on the right track.
And then, boom, the market takes a nosedive. Think dot-com bust, 2008 financial crisis, these things happen. And your portfolio gets slammed with a 50% loss. It's absolutely painful, but it's a real-world scenario that we all have to be ready for.
So your 100 grand is now worth 50 grand. It feels like all that progress just vanished into thin air. So now here is the $1 million question, or maybe the $50,000 question. How much of a gain do you need to get back to where you started?
And here's the part that catches so many people off guard. You might think, oh, I just need a 50% gain to get back. But no, because you're starting from a lower number now, $50,000, you actually need a 100% return. You have to literally double your money just to get back to even. It's this nasty mathematical trap that so many people fall into.
So let's pull out our trusty rule of 72. If you need to double your money, that's a 100% gain, remember. And let's say your portfolio starts growing again at a pretty decent 7% a year. How long is that recovery mission going to take?
Well, the rule of 72 gives us the answer, and it's a bit of a gut punch. 72 divided by 7 is about 10.3. We're talking over a decade. A full 10 years of your investing life just spent trying to climb back out of the hole you fell in. And this is why managing your risk and avoiding those huge catastrophic losses is every bit as important, maybe even more important than chasing big returns.
Okay, so we get the rule now, right? We see its power for growth, and we understand its warnings about loss. The big question is, how do we take this cool little piece of mental math and actually turn it into a cornerstone of a real practical financial plan? Well, a lot of disciplined investing strategies are built on what you could call 4 pillars. You've got fundamental analysis, which is what to buy, and technical analysis, which is when to buy, but the rule of 72 is the perfect tool for those other 2 pillars. It helps you set realistic goals for your cash flow, and it really helps you understand the true time cost of a big mistake when you're managing your risk. Now here's a really cool trick. We can actually shift our thinking from years down to months. See, the periods in the rule of 72 can be whatever you want. So if you set a goal to earn 1% per month, it will take you 72 months to double your money. That's just 6 years. If you can hit 2% a month, now we're talking 36 months or 3 years. And if you're really ambitious and hit 3% a month, that's just 24 months. It's a fantastic way to break down a huge long-term goal into smaller, more manageable monthly targets. So, as we start to wrap this up, I really want you to take this one thing away. The rule of 72 is so much more than just a math trick to impress your friends. It's a whole mental model. It's a lens you can use to look at every single financial decision you make. It helps you weigh the exciting potential for growth against the devastating timeline of recovering from a big loss. And so, this is the question I really want to leave you with. Take a hard look at your own finances, your savings accounts, your retirement funds, your investments. Now, apply the rule of 72. Is the timeline you see looking back at you the one you actually want for your life? And if it's not, what needs to change? Answering that question, that's the real power of this simple little tool. Thanks so much for joining me.